All right, that brings me very nicely to number 3, which is accepting the risk. Do you know, we are very bad at doing this, and this is quite a big topic, but I'll try and touch on it and we'll try and go in as deep as we can in the next couple of videos. Let's keep that nice and clean. Okay, so accepting the risk. What do I actually mean by that? Well, let's put a scenario. And the scenario is there's a games machine. The games machine is you put a pound in, the claw comes out, you know the one, it goes and it grabs a cuddly toy, a teddy bear or whatever. It's supposedly you're trying to get it so that you grab the toy, comes back and it drops it in the shoe. But you know what happens is it picks it up and then it normally drops it there, doesn't it? Of course, it's got a positive expectancy for the machine owner, a negative expectancy for you. Now, the way you play that game is you say, okay, here's a pound coin, in it goes. If I win the teddy, I probably get a teddy that's worth, you know, 5 quid, 10 quid, whatever I have to pay in the shops. If I lose a pound. I'm accepting the risk, I'm playing the game. There's a bit of enjoyment in the game, which should be different from trading. You shouldn't be kind of doing it for fun as such. But, you know, I've accepted the risk and I've accepted the payoff. Now, as traders, we kind of get a little bit caught up in this. Let's use an example. Let's say we've got an account of 100,000. Let's say we've got an account of £10,000. Okay, it doesn't matter what this account is. It could be 1,000, it could be 100,000, it could be 1,000,000. Forget about the numbers as such. I'm just going to use this as a pure example. So whatever situation you're in, whatever funds you've got in your account, you can use this and keep it relevant to what you've got. So forget about the number. So now let's say to myself, okay, I'm prepared to risk. In fact, you know what? Let's make that £100,000. I'm prepared to risk 1% of my trade, or 1% of my capital per trade. So I'm going to risk £1,000 in the trade, because 10% of that will be 10,000, 1% will be 1,000. I'm doing this just to keep the numbers nice and easy for us, even though it would still be easy, but you'll see what I mean in a second. So we're going to risk £1,000 per trade. Fine, that's pretty standard. It's 1% of the capital. It makes a lot of sense. If you had £1,000, you risk 100, etc., etc., etc. Okay, all very well. Are you comfortable with that, sir? Your £100,000 account? Yes, I am. Okay, now you're day trading this. So how many trades do you take in a day? I take 10 trades in a day normally. Okay, so let's multiply this by 10, and that's giving us obviously £10,000. How do you feel about losing £10,000, sir? Actually, I'm not that comfortable with it, because that would mean I'm down to 90k, and I don't really want to be down to 90k. And you say, okay, well, why are you trading with this strategy then? Why are you taking £1,000 risk and you're taking 10 trades? There, at some point, you're going to get to a position where you're in loss for the day you don't want to be in. This is what I mean by not accepting the risk. Yes, you've accepted it on one trade, and actually we're going to get that into a second, because some people don't even accept it on one trade. But let's say you accept it on one trade, okay? But let's say your frequency, that could be 10 a month, by the way. It could be a swing trading account, or day trading account. It doesn't even matter. But at some point, you know, you have to say to yourself, are you comfortable with having your account at this level? And even 1% is quite mild. Most of the time you read 2%, so that would be 20 grand, you'd be down to 80. Now, how does that feel? And they, I don't like that. Well, then you're not accepting the risk of what you're doing, because unless you're pre-planning how you're going to trade, this could easily happen even to the best trader out there. You could be down to 90,000, and if you're uncomfortable with that, then you shouldn't be trading this. You should be saying, okay, well, all right, I'll do 1,000 on my first trade, my first 3 trades, and then my next, I will knock myself down. If I lose 3 in a row, I'll knock myself down to 500 times 3. And then if I'm really bad, I'll knock myself down to 150 times for the last 4, or whatever it may be. Okay, now then we price that up and you say, are you happy with that? Yes, I'm happy with that. Then it becomes, you know, you are accepting the risk of what you're doing. Okay, I've actually jumped ahead of myself with that kind of talk. Let me talk about accepting the risk on the trade. You know, if you think about how a trade is random, then you should be able to accept the risk. And this is a trick that I used to do. If we go back to the analogy of the machine, when you're putting the money in the machine, that money is gone. You're paying that money to play the game. I like to look at trading as in the same kind of thing. I've got a trade set up that I know I want to play, I want to get involved in because I'm expecting that over time I'm going to make money out of it. And let's say, for example, I'm risking that £1,000 in the trade. I will say to myself, and something I used to do to get myself into this mindset, is I would have the stacks of money on the table in front of my desk. I would say, okay, how much do I need to pay to play this, to literally play is the wrong word, but you see what I'm saying, is to get involved in this trade. £1,000 is what my total risk is, which is the distance of the stock multiplied by the position size. We all know that formula. Take the £1,000 stack, put it out the way, put it in a tin or something. There, that's gone. Whatever happens, that is gone. The outcome of this trade may well be that I get more back, as the outcome of the trade is X, i.e. the teddy, to use this bad analogy of the claw machine. I may get more back, but that £1,000 is gone. So getting into that mindset before you take the trade. So the trade's setting up. Yes, I want to take it. What's my risk on it? It's £1,000. Okay, there's my 1,000. I want to play the game. That's a stake in the game, so to speak. Right, here we go. We're in the trade now. If the trade doesn't work out, you've already accounted for that money. It's gone. You've played the game. Too many people, I think, and you guys may know somebody, one of your friends or one of your trading buddies who does this himself. He gets into a trade, he loses money, then he says, oh, I didn't expect to lose that much. Well, how could you not? That's the one thing as a trader you can control, is your risk by your position size and your stop position. Obviously, if you're holding overnight risk, it's uncontrollable, and gap risk is uncontrollable, yes. But generally speaking, you can control your risk. It's the one thing you can control. And you can still control that, by the way, by closing your position before the gap. So you have got control of the risk. But many people don't accept that risk. And especially, I kind of jumped ahead of myself with the compounding risk there. But if you're risking once on a trade and you're accepting that, you take another trade, another trade, another trade. If at any point you're looking at your account, your P&L, and saying, I didn't want to lose that, then you haven't really calculated and accept the risk enough. Let me just go to a point here about further accepting the risk in terms of the risk of the game in total. This is a really high risk game, okay? This is a really broad sentiment on it. You know, we are trading against the very best in the world, and we're trying to eke out a living. We're trying to make some money. The odds are stacked against us, but it's possible for us to do it. Now, too many traders, and again, you guys may know some of your friends and trading buddies as well who think like this, think that this is really easy way to make big money. They think, you know, hey, I've just got to get involved in the market and I'm going to make big money. What they don't understand is that the chances are they're going to slash their account by 90%. You know, the 90-90-90 rule. 90% of your account, 90% of the time in 90 days is what most people do. So 90% of people who open new accounts draw it down by 90% within 90 days. So if you're here and you're longer than that, you're doing a good job and you've got a good chance of making it further. So accepting the risk that we're in, the big risk, the wider risk of the trade. Now, very briefly, again, I don't want to go too much into strategy here, but you've also got to accept the risk. I'm talking this from a psychology perspective in terms of, hey, I'm going to take this trade. The risk on the trade is this amount of money. Do I truly accept the risk? Am I truly happy to put my hand in my pocket and pull out whatever I've got, you know, £4 here, and go, yeah, I'm accepting the risk, as I would do if I was playing a game of chance on the claw machine. Whatever that may be. If that's £400 for you in a trading account, are you prepared to accept that risk to play the game? If you're not, you need to dial down the risk until you get to a level where you're happy to accept the risk.